While the news on mortgage rates has primarily been about inflation and the Bank of Canada's insistence on raising its interest rate to combat it, we do have some good news for you. Fixed mortgage rates have dropped. Leading up to the Bank of Canada's October rate announcement, pricing on the bonds, which are the basis for fixed rate mortgage pricing, was increasing. But after the rate announcement was smaller than anticipated by the market, we've seen downward pressure on the Government of Canada's 5-year bond yield. After peaking on October 20th at the highest rate seen since June of 2008, it has dropped more than 0.75 of a percentage point, and fixed mortgage rates are trending in the same direction. 5-year fixed rate mortgages for 5% down purchases were around 5.5%, and they can now be had for under 5%. This is awesome positive news, and I'll be watching to see if this trend continues, and I'm going to share more about this in the new year. Meanwhile, today, December 7th, 2022, the Bank of Canada made its final rate announcement of the year. In the last week, economists have been pretty split, not on whether or not the rate would increase, but on whether or not it would be 0.25% or 0.5% increase. And well, the bank chose 0.5% increase, boldly placing us in a spot where there may be no more need to increase that rate further. Here's hoping. For those of you with variable rate mortgages, this equates to about a $29 per month payment increase for every $100,000 that you owe. And while the bank won't tell us directly, it did point out that they see that the higher rates have slowed consumer spending and housing activity, and that price pressures on pretty much everything else may be losing momentum. The bank sees the economy stalling as we enter 2023. This rate increase leaves us in a rather unusual position where fixed interest rate mortgages are lower than variable rate mortgages. And usually it's the other way around. It's usually a safe bet that variable rate mortgages will cost less than fixed rate mortgages over the 5-year term of the mortgage. But that might still be true, but the future hasn't happened yet. I will put together another video in the next week or two discussing this odd situation more specifically. So, where does this leave us? Well, different banks have different predictions of what we're going to see, but here is something to consider. Last week, CIBC senior economist Andrew Grantham predicted a 0.5% increase today. And then, quote, before the bank moves to the sidelines in 2023 to observe how the economy is coping with these higher interest rates. In a Reuters poll of 29 economists last week, all but 3 of them predicted that the rate would peak or stop at 4.25%, which is where that is, leaving the retail rate at 6.45%, which is where it is now. This appears to be in line with today's Bank of Canada rate announcement. While I don't have a crystal ball to predict the future and the data continues to inform policy decisions, it does seem that we are at the end of this historical cycle of rate increases. I shared last month that the rate might start to decrease as early as the end of next year or a year from now, and let's hope that that proves true. So what does this mean for the housing market? Well, with rates leveling out now, we can reasonably expect that home prices in Calgary and Edmonton have likely bottomed out or are very close to that. The most recent data for Calgary shows that the average prices have been increasing since August and are leveling out in Edmonton. And over the coming year, if rates remain stable, we should see a corresponding stability return to home prices in Alberta until it starts to look like rates are going to start heading back down, which may actually put upward pressure on home prices. Some economists think that the Bank of Canada may start lowering rates as early as the last part of 2023. Now, what if you're suffering? Well, the banks have been releasing data that suggests that the majority of variable rate holders are in a good, strong position to weather these higher rates. That certainly isn't the case for everyone. There are options available to your lender for them to be able to help you out as long as you reach out to them while your mortgage is still in good standing. They can look at skipping payments or stretching out that amortization to as many as 40 years if you are at risk of missing payments. But again, you do need to start the process or the conversation with them before you miss a payment. Now, Each mortgage is different, so reaching out to customer service at your lender can help you understand which options are available to you. And if you want or need help knowing where to call, please reach out to me or to my office for more guidance. Thank you.